If summarize all rules of the triple screen strategy in one table, we will see the following picture. The first column on the left indicates the status of the major trend, in the direction of which trader should open his positions. In other words, this is the first screen of the triple screen strategy. The information in the second column indicates the status of the intermediate trend, or correction. In other words, here we can see the information about the situation on the second screen of the strategy. The third column shows what actions should be taken by the trader, depending on the situation developing in the first and second screens of the strategy. Finally, the last column shows which type of order trader must use in a given situation. Let's analyze the order of traders' actions in different market situations. Suppose that an uptrend develops in the first and second screens of the strategy. So, in this particular situation, trader either should have a long position, or stay outside of the market. Under these circumstances, he should be busy with position management, or wait for the emergence of a new trading signal. Trailing by stop order is not being used in this situation. Now suppose that an uptrend is developing in the first screen, while in the second screen the market has entered into a downward correction. In this case, trader should be ready to open a long position, and use trailing by stop order to enter the market. If summarize all key information about the rules of the triple screen strategy on one slide, we will get the following picture. On the first screen, trader uses monthly chart and trend indicator, such as EMA13, and his goal is to determine the direction of the major trend. On this basis, he will decide what position to open, short, long, or stay outside of the market. On the second screen, trader uses weekly chart and oscillator, such as slow stochastic with parameters 4, 1, 1. And his goal is to determine the end of correction, which goes against the major trend. On the third screen, trader uses weekly chart without any indicators, and his goal is to locate an entry point into the market. Let's take a look at an example of trade executed in accordance with the rules of the triple screen strategy. To work with the strategy, trader will need to build 3 separate graphic windows in a technical analysis program he uses. Also, 3 charts with the required indicators have to be built: monthly, weekly and daily. Here is the first screen of the strategy, a monthly chart of the currency pair Euro, US dollar. I used 2 vertical lines on the chart, in order to highlight an area where the market developed a clear uptrend. This is confirmed by the slope of the moving average and its position relative to the price chart. The price is above the moving average all the time. Therefore, during this period of time, trader should open only long positions. Now, let's switch to the weekly chart. Here, the same vertical lines highlight the same area. During this period of time, trader should only use buy signals of the stochastic oscillator. They are indicated by the arrows in the oversold zone. Please pay attention to the area of the chart highlighted with a red rectangle. After the candle with a long lower shadow is closed, stochastic oscillator got into the oversold zone. Under conditions where the major market trend is up, and the correction is close to its end, trader should be ready to open a long position, and use trailing by stop order. In order to do this, he should switch to the third screen, and determine the level for placing the order. In this particular example, trader should set his buy stop order 1 tick above the high of the last weekly candle. During the next week, his pending order is triggered, and a long position is opened. Trader should set a protective stop-loss order 1 tick below the local market low. Once the price has moved in a favorable direction a distance comparable to the size of the risk, trader should move his protective stop-loss order to break-even point. Next, as the price continues to move up, the stop-loss order has to be converted into a trailing stop, which can be moved after the price in full accordance with the rules of the strategy. For my part, I can add here that, in this particular trade, a simple technique of moving the trailing stop under the low of the weekly candle leads to a profit of around 1,000 points. The duration of the trade in this case is more than 9 weeks. Thus, within a period of 2 months or so, trader executed only one trade and made a profit of roughly 1,000 points. The efforts of the trader in this transaction amounted to only 5 minutes per week. No doubt, for those traders who cannot afford to monitor the market for a few hours per day, the strategy with the specified parameters can be quite a good choice. However, in case you want to make your trades more frequently, you may need other time frames and indicators with other parameters. You will find another version of the strategy, with the parameters specified, on the next slide. Now it's time to complete my video presentation. I want to thank you for your attention, and wish you all best in trading. Please subscribe to my YouTube channel, and I will keep you updated of all new developments. I plan to launch another series of educational videos very soon. Also, I will be very grateful to you if you recommend this video to your friends. See you next time, and good luck.